There is a clause in your bank's terms and conditions that most people have never read. Not because it is hidden, it is usually on page 11 or 12, written in ordinary language. It describes the conditions under which your bank can restrict your access to your own account. A specific set of circumstances where the withdrawal you expected to make on an ordinary Tuesday simply does not happen. Not because the money is gone, because the rule changed. Most people who hold foreign currency as a hedge against their home currency have not thought carefully about that clause. They have thought about the exchange rate. They have thought about which currency is stronger. They have watched the numbers and made a reasonable calculation. The exchange rate question is real. It just turns out to be the second question. And the gap between the first question and the second one is where most of the historical damage lives. What follows traces 4 moments where foreign currency did something nobody in the financial press had fully predicted. Not 4 disasters, 4 reveals. Each one answers something the previous case left open and opens something the next case has to close. Start in Turkey. Not 2018, not the recent lira spiral that made international headlines. Go back further. Go back to the 1990s, when Turkish households had already been living with high inflation for 2 decades. By the mid-90s, Turkish savers had learned something through experience that most financial education skips entirely. Holding lira was a slow way to lose. Holding dollars or Deutschmarks was the obvious alternative. Not because of financial sophistication, because every working family could see it in the grocery store, in the rent negotiations, in the price of anything imported. The lira eroded, and foreign currency held in a mattress, a safe, an envelope held its value. By the early 2000s, somewhere between 40 and 60% of deposits in Turkish banks were denominated in foreign currency. This was not irrational behavior. It was the rational response to a long track record of inflation Turkish households had created, organically and through hard experience. One of the most dollarized economies in any country that was not formally dollarized. They had answered the devaluation question correctly. But there is something that happens in a highly dollarized economy that almost no discussion of foreign currency hedging mentions. When a large portion of savings, loans, wages, and contracts run in a foreign currency, the domestic economy becomes sensitive to something it cannot control: the decisions of the Federal Reserve. Turkish families holding dollars were protected against Turkish inflation. They were not protected, could not be protected against a sudden strengthening of the dollar driven by American monetary policy. When the Fed raised rates sharply, dollar-denominated debt across Turkey got more expensive. Businesses that had borrowed in dollars to fund construction projects with lira revenues suddenly found the arithmetic had turned against them. The companies could not pay. The banks held those loans, and the currency that had felt like protection started to reveal its second face. The people who had saved in dollars were fine for themselves, but the economy around them was not fine, and eventually, the instability of an economy that has effectively split its financial system into 2 parallel currencies creates conditions where neither one feels entirely safe. This is the first reveal. Foreign currency protects the individual saver against devaluation, but it does something else to the economy as a whole. And what it does to the economy eventually comes back to the individual saver in a form they did not expect. Keep that in mind, because the next case shows the same mechanism operating in a matter of days, not years. Cyprus. March 2013. If you held an account at one of the 2 largest Cypriot banks, the Bank of Cyprus or Laiki Bank, the banks were simply closed. Not failing, not technically insolvent in the way that word normally works. Closed by government instruction. For what the official language described as a temporary period necessary to prevent a bank run, the initial proposal from European creditors was straightforward and shocking in equal measure. A one-time levy on all deposits, regardless of size, to fund the bailout. Insured deposits accounts under 100,000 euros would pay 6.75%. Uninsured deposits would pay 9.9%. The Cypriot parliament voted it down. But in the days it took to reach that decision, nobody could withdraw anything. What is less often discussed is this: the restrictions that eventually came into force applied to all currencies, not just euros, all currencies, in all accounts, at all Cypriot banks, including the branches of foreign banks operating in Cyprus. If you had held dollars specifically because you distrusted the euro, your dollars were frozen alongside the euro accounts. The currency question had been answered correctly. The jurisdiction question had not been asked. The capital controls that followed remained in place for 2 years, not 2 weeks, as originally promised. Not the 7 days the legislation initially authorized. 2 years. And within those 2 years, withdrawals were capped at €300 per day per person. Transfers above €5,000 required central bank approval. Students studying abroad could receive no more than €10,000 per academic term. The government was exempt from the controls. The citizens were not. A person who had held foreign currency in a Cypriot bank account specifically to avoid the risks associated with euro area instability had the right asset in the wrong place. The currency had not failed them. The infrastructure through which they accessed the currency had. This is the mini payoff that Cyprus delivers. The answer to which currency is almost irrelevant if the answer to where is it held is wrong. 2 different questions. Most financial discussions collapse them into one. The next case opens something stranger still. Iceland, October 2008. In 1 week, all 3 of Iceland's major commercial banks collapsed. Not weakened, not restructured, collapsed. The banking sector had grown, in the years before the crisis, to roughly 10 times Iceland's GDP. These were not small, local institutions. They had taken on foreign currency debt from international markets, offered high-interest accounts to depositors across Europe, and financed an expansion that depended entirely on continued access to cheap foreign borrowing. When that access closed overnight, after Lehman Brothers failed and credit markets seized globally, the banks had nothing to draw on. The Central Bank of Iceland could not function as a lender of last resort in foreign currency. Its reserves were not remotely large enough. There was no mechanism that could fill the gap. The krona had already depreciated by roughly 40% against the euro in the months before the collapse. Within days of the bank failures, it was trading at levels that suggested a complete breakdown of confidence in the currency. Capital controls were imposed in late November 2008, blocking all outward capital movements. The official intention was temporary stabilization. The controls stayed in place until March 2017. Not months, 8 years. Here is the thing that makes Iceland different from what you might expect. Iceland had depositors who had done the right thing. British and Dutch citizens had placed money in Icelandic bank accounts, specifically IceSave accounts, run by Landsbanki, because the interest rates were better than anything available domestically. The accounts were real. The interest was real. The currency, the deposits were held in local currencies. Euros and pounds was sound. And when Landsbanki collapsed, more than 500,000 people across Europe discovered that their access to those accounts was gone. Not temporarily restricted. Gone. Iceland's domestic depositors were protected. The government guaranteed all domestic deposits and separated the failed banks into domestic operations, which would continue, and foreign operations, which would not. The foreign depositors were left holding claims against an insolvent estate. The legal dispute over whether Iceland was obligated to make good on European deposit insurance guarantees went to the EFTA court. Iceland eventually prevailed. The depositors in Britain and the Netherlands received partial recovery through lengthy proceedings. Some waited years. What Iceland reveals is something that does not appear in most discussions of currency hedging. Access to your money depends not just on what currency it is in, or where it is held, but on what legal jurisdiction governs your claim if the institution fails. The geography of your deposit is not the same as the geography of your rights. And when an institution fails across borders, those two geographies can diverge in ways that take years and courts and international arbitration to even partially resolve. This is where the pattern across these three cases begins to show its shape. Not all of these crises were the same in severity or duration. Cyprus was severe and medium-term. Iceland was severe and long. Turkey's dollarization story was slow-moving and structural. Some people recovered quickly, some waited years, some received partial restitution through legal channels. The range of outcomes is wide, but in each case, the variable that determined the outcome was not the currency chosen. It was a different variable entirely. If you have watched your own country navigate something like this, a freeze, a restriction, a conversion, comment the year below. The next part of this pattern is the one that most people find genuinely counterintuitive because it shows a case where the foreign currency hedge worked perfectly and still produced the wrong outcome for many of the people who held it. Malaysia, September 1st, 1998. The Asian financial crisis had been moving through the region for 14 months. Thailand's baht had collapsed in July 1997, and the contagion had rolled through Indonesia, South Korea, the Philippines, and Malaysia. The ringgit had fallen from roughly 2.50 to the dollar at the start of the crisis to nearly 4.80. The Kuala Lumpur stock market had lost approximately 70% of its value. Malaysian Prime Minister Mahathir Mohamad made a decision that virtually every international financial institution advised against. He pegged the ringgit at 3.80 to the dollar, halting currency speculation instantly. He imposed capital controls that prevented foreign investors from repatriating funds for 12 months. He shut down the offshore ringgit market, which had been operating in Singapore and London, used by speculators to short the currency by making ringgit non-legal tender outside Malaysia and requiring all ringgit held abroad to be repatriated within 1 month. The consensus in international financial circles was that this was reckless. It would destroy investor confidence. It would isolate Malaysia from global capital markets. The IMF had recommended the opposite approach: high interest rates, fiscal contraction, currency flexibility, and the countries that followed that prescription, Thailand and Indonesia in particular, went through severe recessions. Malaysia lowered interest rates and increased government spending. By the end of 1999, the Malaysian economy was growing again. Now here is the part of this story that does not get told. Foreign investors who had moved money into Malaysian assets in the years before the crisis, people who had held ringgit-denominated investments specifically because Malaysia appeared to be a strong emerging market, could not get their money out for 12 months. They had done nothing wrong. Their assessment of Malaysia's economic fundamentals had not been obviously mistaken, but the government's response to the crisis applied to them. They were caught inside a system that was restructuring itself, and their timeline for exit was not their own to set. The people who had held foreign currency dollars, sterling, Deutschmarks outside the Malaysian banking system, in cash or in accounts held in other jurisdictions, were unaffected. They were liquid when the controls arrived. They could move. They could buy. In the months when Malaysia's asset prices were at their lowest, that liquidity was worth considerably more than the currency value alone. And then something else happened. The people who waited, the foreign investors who sat through the 12-month lock-in recovered. The ringgit peg held. The economy grew. By mid-1999, those who had stayed in were in better shape than many had predicted when the controls were first announced. Some of the worst-case scenarios that global commentators had described did not materialize. Malaysia had used capital controls as a firewall, bought itself time to restructure its banking sector, and emerged without an IMF program, without a sovereign default, and without the social upheaval that had accompanied crisis responses in neighboring countries. This is the structural reversal. The case where the foreign currency hedge mattered most was not about the exchange rate at all. It was about being outside the system at the moment the system temporarily closed to outsiders. And the people who survived best, and who actually rebuilt the fastest, were not necessarily those with the strongest currencies, but those with the most liquid, accessible, outside-the-system position at the precise moment. Access became the rarest thing. The distinction between being in the right place before a crisis and being in the right place during one turns out to be a question of timing that most people never fully separate from the question of positioning. Both matter. They are not the same matter. Put these four cases together, and what emerges is not a lesson about which currency to hold. It is something narrower and more specific than that. Every one of these cases, Turkey's structural dollarization, Cyprus's bank holiday, Iceland's cross-border collapse, Malaysia's capital controls, involves a moment where the person's relationship to the system they were embedded in determined the outcome more than the currency they held. Turkish families holding dollars were embedded in an economy that had partially transferred its vulnerability to a currency they could not influence. Cypriot depositors were embedded in a jurisdiction that could, and did, apply restrictions uniformly across all currencies. Icelandic foreign depositors held the right currencies in an institution that collapsed, and then had to be sorted out by courts across 3 countries over several years. Malaysian foreign investors held their positions correctly until the rules around repatriation changed overnight. In each case, the surface problem, which currency should I hold, had a defensible answer. In each case, the deeper problem was about embeddedness. How deeply inside the system are you? How many decisions that affect your access to what you hold are made by people and institutions you cannot influence? How many steps exist between your claim on the asset and your ability to use it? The people who rebuilt fastest after each of these crises shared a characteristic that had nothing to do with which currency they had chosen. They had a position outside the system that was under pressure, cash accessible immediately, assets in jurisdictions that were not involved in the crisis, claims that did not require an institution to honor a promise before they could be realized. The currency was a component. The position was the thing. Your savings terms and conditions include a clause, somewhere around page 11, that describes when normal access rules can be suspended. Most people have never read it, but the historical record suggests it is worth finding, because the clause is not theoretical. It has been activated, in wealthy and stable countries, within living memory, more than once, and every time it was activated, it applied uniformly across currencies, across account types, across depositors who had done nothing wrong. The question to sit with is not which foreign currency is strongest today. That has a real answer, but it is the second question. The first question is this: of the assets you currently hold, how many require an institution, yours or someone else's, to make a favorable decision before you can reach them? And how many would remain accessible regardless of what any institution decided, in any country, on any particular Tuesday morning? That number is worth knowing. And it is more specific than most people think.